Hey everybody, welcome back. Wild week to say the least. We can see the sell-off, but it's going to drop a line here. We have four major topics to go over. What's going on with regional banks, why NFP acted the way that it did, smart money, dumb money, and one other topic we really have to dive into here. But if we just take a look at the basics, all we've done is just really come back to our level right here. So are we in some kind of new bear market, or did the market just go down for the first couple of days as it usually does after a monster year? You had a monster year. If you take a look at it, you can see it. It doesn't feel like that for people that didn't play it. But in November, when Powell changed his mind and said, we're not doing any more rate hikes. And then again, when you come right into how we played right into, we're going to start doing rate cuts. Maybe we got a little ahead of ourselves on the 10-year and 20-year bond, and we're going to dig into that a little bit today too. I think that that's pertinent. So a lot of topics we're going to cover broadly and somewhat deep, but we're not going to dive completely deep into them. We're going to do that during the week. I just want to just point out and just be Captain Obvious. This is all that's happened. So if this is causing you massive amounts of pain, there's something wrong. This should not be causing you massive amounts of pain. Now, there are some basic things that we should overlay here. Number one, you are below the 12. You are below the 22, and here's the 55. We do have a negative divergence, and we should point that out. You can see right in here how you have a higher high, and then you can see down here how you have a lower high. And obviously that gives you a negative divergence on the RSI. I do pay attention to that, and it's certainly something that I would suggest that you pay attention to. They come home to roost. It's not a question of if, it's always a question of when. You had one back here as well from June to July, but this was triggered by a macro event. Do we really have a macro event here that's triggering us? Not non-farm payrolls? Did that really do it? I don't think so. I don't think it was. As a matter of fact, if you were on the pre-market live call that we do every morning, you knew that we were probably going to rally. Well, let me rephrase that. I stated we were going to rally, and I believe that we were going to rally off that news. It doesn't mean that it was going to happen, but it did happen. And if you were on that call, and we did in the community as well, we went long. And we did fairly well with that move. And the reason I'm saying that is once you understand what these numbers are, you can do a lot better. But okay, so here we are on the hourly, and let's just take a step back and take a look at how this has played out since we began the year. And it's not been great. If you just look at the hourly, you can see your breakdown right here, previous, and you just see how we acted right in that level. Way, pop that in. And I appreciate the comments about don't worry about the editing. I can pack more information in. The less editing I do, the more research and the way I can put processes together and just show you the data on what I'm really looking at to plan for next week, which is what these Saturday videos are all about. So I appreciate that. I mean, that's not really rocket science, is it? You have a level right here. That was support, tried to hold, support, breaks, tries to flip it, support becomes what? Resistance. So does this seem like something that we might want to pay attention to now that might be a key level? And the answer is yes. Let's get that to an arrow. So now you can see the arrow. And so what we're seeing is we're seeing that resistance after you're seeing support levels right in here. All right, so now you've got this kind of hump, which doesn't make me feel, as I like to say, warm and fuzzy. If we just drop the most simplest of things there, it's just drop an RSI reading. All right, well, we're overbought and we're starting to work that off. Does that mean that we should just be jumping in? No, but it does mean that we just came back to that one very specific point. And the other thing that I would point out too is let's just drop this up here and leave that up and pull this down and just look at what's happening here. You were grossly oversold. And I was pointing this out before. If you came to this level, it doesn't mean that you're just going to go up, but it does mean that you are at a point where you might want to pay attention to it. In other words, you start coming down here, you can see this again, positive divergence right here on the 4 hour, and you see how you hit that lower low, but at the same time, what did you do? You hit a higher low here, right? And if I move that out of the way for a moment, I'll just drop that up here. But if you hit that higher low for a moment, what happened there? You put a bottom in, all right? So one of the things I like to say is people don't really believe in these. That's fine, you don't have to. I like to say if you don't have to believe in gravity, it's still there. But obviously these don't work all the time like gravity, but that's the best example that I have. And it's something I certainly pay attention to. And I would strongly suggest that you pay attention to it because once you understand what it is, it starts to make a heck of a lot more sense. So for example, if you start seeing the higher high here, and then I'm going to go off on a tangent here because I think this is a really important lesson. You see your control bar right here? Control bar is where it changes the dynamics of a chart, right? So in other words, if you have a control bar and you break down like this and you can't get above it, guess what bar is in control? That one. Right? It's not really a rocket science concept, but you get it. This broke down, can't get above it. This bar is in control. That means that this bar usually becomes a resistance point if it can't flip, which you can't do right there, right? All right, control bar, learned a new term. See how you are right here? See how that's hitting a higher high? See how you're unable to get above that? What happened here? Now, some people say, well, it's this. Well, you don't know that this exists. All you have is this over. All right. So when you start to see stuff like this, what do? You pay attention. And this got us to be a little cautious going into the beginning of the year. We knew that the beginning of the year, it was pretty obvious the beginning of the year. If you did any kind of trading over more than 5 years, you know that the first beginning of a year after a record run like we had last year in that bull market, that it's pretty clear what's going to happen, right? That you're going to always have selling of the big winners, but that's a story for another time. So this is the hand that we're dealt right now. We could see the lower low. We could see that we're just getting to that overbought level, and we're almost at neutral, which I kind of like. But the way that I look at the world is I always look at these 3, 5s, and 8s. And I'm just going to point this out to you as well. So this is something that I use that really saves me a lot of time. I don't just use the 5. A lot of people will just use the 5 and say, oh, when it's above the 5, I'll buy. And then I want the slope. I'm going to look for the slope, and they'll do something like this and say, I'm going to wait for, this to turn this way. That's great. But by the time that happens, you're probably missing the move. And people will say, I don't want to catch the bottom. Everyone trades differently, and you have to respect how everybody trades. I'm just going to tell you this, that the best traders in the world, they're trying to catch the turns. Okay? If you ever read anything by Paul Tudor Jones, they're trying to catch the first 10% of the turn. Always. That's their style. People say, oh, I want the meat, or I want to follow the trend. You go look at turtle traders and how they trade. All they were trying to do was catch when the trend changes. People say, oh, it's a trend following system. It's a trend following system when they're trying to pick up where the bottom, they're trying to determine when the trend's going to change. They're not saying that, oh, we're just going up, so we're just going to buy with it up. No. So I'd spend a lot of time really, and I did this when I was younger. I still do it and refresh, but try and study like traders, like real traders. Like real traders, people that literally have made billions of dollars trading. And you'll find they usually have one thing in common. They want to know the inflection points. Okay, so what I tend to do, and where am I going with this besides a rant? Where I'm going with this is you have the 8, the 5, and the 3 here. Okay, you can set this up anywhere you want. You can put this on a half hour. I like it on a 15-minute. It doesn't matter, but that's what this is. This is an 8, a 5, and a 3. And they are simple moving averages from a daily chart, and then you just extrapolate them out onto a 15-minute or half-hour chart. You can do the math yourself, right? You have 6.5 hours a day, do some division, and you're there. And what I'm trying to do with this is 8, 5, 3. All right, see how you turned here? See how the 8's at the top, 5, 3. Okay, do you think that's going to give you an inflection point? Do you think that that's a more clear inflection point than just having something like this? And again, I'm going off on a tangent here, but the more I think about some of these things, the more pertinent I think they are. So we're going to spend a moment. So what's more important? Looking at that line and going, oh, it's kind of turning here, right? Or it's kind of turning here. Or then all of a sudden having something where you could look at this and go, well, yeah, I understood we broke here, but we never really got below, right? This, like they didn't really flip, right? So all of a sudden you're like, yeah, you have that cross and these are starting to break down in here, but you really didn't get what you wanted there. And then all of a sudden they flip here, right? So this might have given you a little more comfort that you might challenge the top of this again. And then this is telling you something that no one else is really telling you. Because if you're looking at your 5 right here, you really haven't broken yet. You really aren't on that major downtrend unless you're going to get really, specific. What do you have here? You have a cross of all 3 of them at the same time. So that's pretty glaring, right? So what I like to do, if I'm trying to see if we're going to turn or not, is I want to start looking at the 3, the 5, and the 8. Because if you think about it, the 3 is going to go flat before the 5 is. Doesn't mean you act on it. You can see how you're popping over here and you're getting completely matumboed. And you can see how it's getting tighter. But you can also see that you're starting to see a little bit of a change, aren't you? So, and where is that change? You see your trend line right there. Right? You could always just clone these, right? If you hit that clone button, and then you could just drop this up there. This is really important, so I'm going to spend a little time on it. And you just see, okay, so I've kind of got this trend, and when we pop out of it, this is kind of what happens, but it's not perfect. Nothing really is it? So now we're going to look at this and say, when this 3 and 5 start to cross, there's probably a pretty good chance that we're hitting a bottom or at least getting exhausted from selling. When all 3 of these cross in line like this, that's usually a pretty clear indication that you want to start paying attention, right, and getting involved. So that's one thing that I utilize a lot and one thing I would tell you to pay attention to. In the meantime, the way that I look at the world is this, 12, 22, 55. If the 12 and I am below the 12, to me that means that swing trades are a lot harder, especially if you have the confirm down. 22, you broke, now you have a doji. Dojis are what? Signs of uncertainty. Why do you want to play with it? Let it figure out what it wants to be when it grows up. Why do you have to be a hero, right? But you want to take this and then drill into smaller time frames, and here's your 55. All right, so a little bit of a tangent there, but the more I looked at it, the more I think it makes sense before I kick into some of these bigger topics. It's because the question you're going to ask as you go through all this stuff is, okay, this is great, Tone, but how do I know when we're going to come along and it's time for us to move, right? Like when, oh, great, this is all groovy, but like how do we move? When do we act, right? That's what you always have to think about. All right, so you come up to your level, you're trying to break, and all you do is retest. Do you really think that you need to be that concerned about this? If you were looking at a chart, and this was the chart that you had on a weekly basis, and you were looking at this move down, is it really the end of the world if this is going to happen? I'm not saying it is, but let's just put things in perspective. All right, so then you come and take a look at the cues. Let's get rid of, well, before we get rid of our nonsense, let's go here, because this is going to be important, and I don't want to get rid of it. And so we're going to backtrack a little bit. Let's go to a 5. So, and let's go to a plane. So one of the things that we do, and I would suggest that you do on the live call, the pre-market live call, let's take this down. Obviously, you know you had volume, you had non-farm payrolls. We're going to go through non-farm payrolls, and I want people to understand what happened with non-farm payrolls. But I'm spending a lot of time on the indexes because the way I trade is top down. It's index sector stock, and what you're seeing right here is pretty clean. It's pretty obvious stuff, and it's stuff that you can do at any time. When you have an economic data report coming out, and if you're not looking at economic data reports right now, you have an issue. You need to get involved in macro. I'm not going to bring out the stool. I'm probably going to bring it out later, quite frankly. But when you have these kinds of moves, I'm just going to drop that to a 1, make sure that I had it right where it's supposed to be, because it's different on a 5. When you drop this down and you have this economic data that comes out, you need to start learning economic data, especially for this year, right? You don't have the same market you had 3 years ago. You don't have the Fed backstop. As a matter of fact, you have the exact opposite of a Fed backstop. I'm going to show you that later with what's going on with regional banks. But look, so you mark off when the data hits. Data hits here, 1 minute chart. This is where the algos are. People always would say, oh, you can't day trade anymore because the algos and high frequency traders, they took the alpha out of the market. They did the exact opposite. They created opportunity because they have to show you their hands. At some point, they have to stop, right? So you mark, okay, breaks, where's your con for a move? Don't get it, get an H. What's the fastest pattern that ever bounces? Failed H patterns. Any failed pattern, if they fail, they bounce. I mean, that's not rocket science, right? So like you try to, here's your H, the H doesn't break, it can only go one other way. So you start to lift, you put a VWAP there so you can just see what's going on in your world and you watch it play out, tries to rally, fails. Always, not sometimes, always drop 50% on that first 1 minute bar. It will tell you when it flips and who's in charge. It's not 50, is not a fib level, but what you do is you just go to your fib up here. Well, you can't see it, but you have fib retracement right here on TradingView. It doesn't matter where you do it. And all you're doing is clicking on that, and then you're just making it a 50% line, and you're dropping it right in, and you're marking the 50% on that bar. Now, look what happened when you got to it. You got rejected. We can get rid of that 55 here to make this super simple. And what are you trying to do? Bonk, comes back, tests VWAP. Okay, so now I break through VWAP. I have a retest of VWAP, and then I break the 50. I come up, and then I hold the 50. This is why we went long. If you listened on that pre-market live call, you could hear the little thing dinging where I think I even said I'm going long. On the call, we were talking about it, that we were going to rally. We're going to get into why we actually did rally. But these become demarcation lines. For the rest of your day, on that day, these will be demarcation lines. If you look right here, look what happened with NQ. All right, so again, one thing to take away from the video, if you haven't taken the other 3 or 4 like major things I just pointed out, you want to take away the fact that you always want to mark these 830 bars. Always want to mark them, especially when you have economic events. And you need to learn macro. I always get asked like, well, how do you learn macro? You keep saying that. I go over it a lot in these videos. Let's just say that you don't like me and you don't like these videos. Go get a book called The Hedge Fund Edge by Mark Boucher. Okay, excellent trader. And he realized a long time ago that he was very similar to me. I think it's why I like him, where he was trading and he was doing great. And then he would just get clocked and he couldn't figure out what happened. And then he started understanding the macro and how money moves through the global economy. It's not that hard of a read. And he gives you very specific things that you need to pay attention to. And it makes a huge, huge difference. So, but you can see how you respected these levels. Now, you'll see, well, that's just ES or that's just NQ. It doesn't matter, guys. It really, really doesn't. You can go to any one of these and you're going to see the same exact thing, the same exact movement. And then you're just here, just for time's sake. If you just took that 830 bar and you just dropped that down, do you think that you should know where these levels are? Do you think it might be something that's pertinent to you? I would suggest that it is. And it does, again, it's not going to matter if we go up here and just drop the anchored VWAP as well, just on that 830 bar. You know, is that something that you might want to pay attention to? I don't know. Maybe. Kind of odd how the 4 o'clock level just happened to fit right across the anchored VWAP from the 830 bar, but what do I know? Or how you stopped here, right? Meanwhile, people are watching 930 and trying to figure out what's going on. You want to know where your algos and high frequency traders are. They're your enemy, right? So the more you know about your enemy, the better, right? Okay. Tries to rally up, pulls back, holds. And the one that I was most interested in that I do think is going to lead, and the one that I traded was the Russell. And we did really well with this trade. But you can see your levels right in here. They're all marked off. Here's your VWAP. Look at that. Another Christmas miracle right to the 4 o'clock, and you stopped from the 830. So it's almost like it's planned to some extent, right? Like someone almost has like a buy order or a sell order out there all day. So here you are, and you're flipping, you're fighting it. What do? You retest, and then you also retest up what? 50, and then you break. And then you get to this level, and you test, and then you come back, flips. I'll stop saying flips, and then pushes. And what is this telling you, right? It's telling you exactly the levels that you need to know. All right, so now you know how you should be trading economic data when it comes out. Stop telling economic data what it's supposed to do, right? Start understanding what economic data is, and then start understanding how you can make money. That's the best thing that I could tell you. Let's get rid of these levels, and let's just talk about this. Does this look like something on a weekly chart that we need to be concerned about? And I am going to show you something that you're going to say, well, you said not to be concerned, and now you're telling me you're concerned. So there will be something like that as well. I can only point out what's going on, guys, right? That's all I can do. But am I concerned? I'm not feeling warm and fuzzy. I mean, I really don't want to reject it the same spot over and over every day. It's like that movie Groundhog Day with Bill Murray. Every day he wakes up, that guy tries to sell him insurance. But you see where I'm going here? I mean, at some point, you're going to break this. And I thought it might be now because of what's going on in the bond market. We're going to talk about that as well. But it doesn't seem like we're going to break. And this non-farm payrolls data that came out, it really shook the market. But again, another thing you could always do, and I'm just going to give you another tip here because we need to understand non-farm payrolls and what's going on there before we go any further. If you start to look, let's clean all this off. If you start to look at the most simplest of levels and you just say, okay, well, what time is this? It's 8:30. So if you just mark the 8:30 level and go, okay, well, this is how far they sold bonds. That's where they sold bonds. Okay, since then. One of the key things people said, how did I know the market was going to turn at 8:30 when they were on like the live pre-market call? And they're like, how did you do that? How did you know the market was going to turn? Because at the time I was even doing the pre-market live, I also have the community up and I'm actually putting stuff in there. That I see. That's why every once in a while you'll hear me on that pre-market live call. I'll say, hold on, guys, because I'm either trading or I'm doing something. But if you came here and you mark that level from the 830 on the VIX, and then all of a sudden you start seeing you break that level, why are they selling volatility? Aren't they concerned about non-farm payrolls? So this was a glaring sign to me, as one of the people that watch this video like to say, absolutely glaring sign that something was not right and that we were probably going to rally. And to me, that made a really nice place to put a trade on because you had very little risk, right? Putting that trade on, you just were using the low of that 1 minute 830 bar as your stop. You quantify your risk, you put the trade on, it works or it doesn't. It's really that simple. You're making an educated guess, right? That's what you're doing. So when we start to see this let me think that the non-farm payroll data was going to be very similar to what happened a couple months ago, but we really should take a look at that non-farm payroll data before we go any further. Now, before we get into exactly what was wrong with the number, let's start talking about what the number is. And then we're going to do a little bit of a deep dive here so that people can understand that. It's really important to get this concept because what happens here is the devil's in the details. A lot of people will look at this data and then go, boom, this is what it is. That's it. I like to say you're playing against the smartest, most disciplined people in the world. So you need to act like it. You do not have to get into the level of detail that we're going to get into here, but you need to understand it. Because if you understand it, then you can look at it at a glance and go, oh, it's this. And then you can go from there. I'm going to give you a real quick way to do that. So the very first thing that you're going to look at is here's your actual. Non-farm payrolls comes out December. This is trading economics. Everything that I'm going to show you in the next 5 or 10 minutes here is free. You can do all this yourself, and I'm going to tell you where the sites are. So you can play around with it and look at the data and get a real understanding of what's going on under the hood with this economy. So you can see right here, non-farm payrolls actual. You can see the previous, you can see the consensus, and you can see the forecast. So this comes out, boom, initial reaction. We saw that market plummets, everyone panics. Then we get our levels. All right, so this is what happens now. Unemployment rate stays the same, which is kind of interesting because how does the unemployment rate stay the same? if people are getting more jobs from non-farm payrolls. Hourly earnings stays the same. Hourly earnings year over year upticks a little bit, not the end of the world by any stretch. Now, this is where it gets really interesting, and this is why I would suggest using trading economics versus using something else, because there's other sites like investing.com, but they don't go into this level of detail at a glance. So the very first thing you can see at 8:30, well, previous was 37,000 jobs from the government, all right? So now the government gave 52,000 jobs. All right, so right there you have an addition of what, right? Way more than you had here. So at a glance, you could just go, wait a minute. So this 216, that's because the government's giving people jobs? Well, I wonder why they would do that. Well, maybe they need them, or maybe they're trying to inflate this number and say, look how great things are. You know, every administration does this. Let's just be real clear about that. And then it comes home to roost after the election year. That's usually what happens, right? It's the same game, same superheated. Next, you would just look at manufacturing jobs and just take a quick glance. What happened in manufacturing? Well, previous, you were here at 26. We came in at 6. So you lost, forget about your consensus or the forecast, okay? You lost 6K. So here's 6K, you lost 20K. So out of this number, you lost 20,000 from a month ago. You lost 20,000 manufacturing, no matter how you want to look at this data. That's not ideal. I don't care if they were thinking that it was going to happen or not. It's not ideal, and it's not ideal that you tried to fill it with almost roughly the same number of government payroll jobs. All right. So this is where you're at. Non-farm payrolls, the private sector, that ticked up, and that could be a concern. And that's something you want to look at. What I always tend to do is you want to watch that first half hour and then watch how the market moves from that first half hour. And you can go mark the 10 a.m. level. We may do it if we have time. But more importantly, what you want to focus on is everyone's starting to say, oh, it was the ISM services PMI that saved us. Well, we were supposed to be at 52 and you contracted. So this is not a huge contraction. And the fact that people are saying that this is going to be the thing that dropped the market or rallied the equity market, meaning dropped yields, is just absolutely silly. It's not. Yields didn't move when this happened. Factory orders came in month over month and they were significantly higher. Okay, previous were a loss, you came in significantly higher. This shows an overheated economy with the factory order. Business activity was up. All right, you could say service employment, this should scare everybody, but service employment was down. Services employment going from 50 to 43, just so you understand how these numbers work, right? 50 is pretty much where they try to keep you. 45 is contraction, 55 is a major expansion. So this is really, really bad, like not good. Let's leave it at that. All right. New orders, they're right in line. So now we have a picture of what happened. You have a non-farm payrolls number that got everybody a little giddy. But as a glance, you now know that you could go to this site for free and you could look at this for a glance and go, well, you know, it all really happened through government jobs. Manufacturing was in the toilet, but payrolls on the private sector, they were up a little bit. I wonder what kind of jobs they were. Now, this is another free site, and this is Fred, St. Louis Fed. And it's just called Fred. Not really sure how they got the R in there. Maybe from economic research, but nonetheless, here it is. And this is the deep dive that people do. And we're just going to do a little bit of it just so you can understand it. So this is just multiple job holders as a percentage of employed people. And this is going to go to 94 to 23. So you can see. And you can see that you had multiple job holders as a percentage, meaning some people trying to work 2-3 jobs, get ahead, plummets, right? Plummets, goes sideways for a number of years. What happened during this period of time, I wonder, that would have kept you from having any kind of vacillation? We had zero interest rates for that period of time. Okay, zero interest rates means you don't have to go out there and get multiple jobs or drop another job or get another job because interest rates were just basically stagnant. So you didn't really have to worry about inflation or new payments or your payments rising or dropping. You didn't have to deal with any of it. All right, so here we are. We have a pandemic. And what's starting to happen here? Well, this latest data report, we just hit all-time highs as multiple job holders as a percentage of employed people. Now, this is really what I want to show. I want to show a couple different charts here, and just stay with me, just so you can understand what's going on under the hood. All right. So this is blue is when they released the data as of December, and this is when they fixed the data. All right. So what are you seeing here in August, September? What are we saying? What's happening is multiple job holders as a percentage of employees, they're raising it after they release it. So after they release the data, to make it not look as bad as it is, you can actually see it's actually worse, okay? You can actually, and we haven't had the next revision yet. You can actually see that it's actually higher on a percentage basis than what they're telling people. Multiple job holders, primary, secondary jobs, both are full-time. Look at where you are, all right? So maybe you're starting to slow down, maybe not. Maybe they're gonna revise that again. This is from 94 on. Multiple job holders, primary and secondary jobs, both full-time. How many people are currently now in the thousands that have to work 2 jobs, right? So if you look from 20 on and you look from inflation on, right? So obviously we had something happen in 2020, and then you look at how long this has been going on. no time since I've been trading, so I started trading actually like back here, no time since I've been trading have we had multiple job holders have to have 2 jobs full time. There's been no time in history it's been like this since I've been trading. This is really important because it shows under the hood how tough things are out there. And the reason that I'm showing it this way is not because it's tough out there. What we're doing with this data is we're trying to understand where they're going with it and why they may have to cut rates sooner than people think. Okay? You can't work 24/7, right? I mean, I like to work a lot because I enjoy what I do, but you just can't do it. Multiple job holders, full-time, secondary, part-time. Look at your level and look at where you're at. So the amount of people, multiple job holders, primary full-time job, and then they have to get a second part-time job. Let's just call it 40. Well, you go back to 90s, we'll call it from the 90s high, right? So this is what's going on, and it's actually getting worse. It's not getting better. Now, to me, this was I'm just going to refer to this as just an outlier statistic, but it's one that I want to focus on. Multiple job holders as a percent of women. So let's say that you have a family and someone goes to work, right? Someone stays home. Okay. So the majority of time, if the woman has the child, they're staying home raising the child. All right. I don't think that's too old school for everybody. And so you're taking a look here. And now all of a sudden there's conversations going on. You need to get a job. We need to pay the bills. And so when you start looking at that, right? I mean, that's why this is happening. If anyone has a better reason why this is happening, right? Let me know. But you're at 20-something year highs. Why are we going through this? Because when you look at data, like we're looking here at Nonfarm Payrolls, there are literally people that have access to large institutions, investment banks that are scouring this data to look for signs of it. And as they're processing that data, they are relaying it to their research departments. They are relaying it to their sales departments. Okay, this is not insider trading, guys. This is called research. This is what you need to do to get an edge. And so understanding this stuff, it's why I said that you might want to read that book, The Hedge Fund Edge by Boucher. So, and the reason for that is it's a really good book, but it also outlines why this stuff's really important. And once you understand it, you can see where you're going. How does this help you with Friday, and how does this help you going into Monday? A couple things. Number one, the majority of people that think that this is really good news, like the current administration is portraying it's really good news, it's not. And it's not an outgoing administration. Every administration does it, right? They all get their news cycle spun up and they get it out there. It's just things are a lot faster now than they were about 30 years ago. What we have to do is parse that number out and take a look at it. And that's what investment banks did for their clients. And they do it at such a breakneck speed that it's hard for us to get an edge on it. But if we can go out there and use a free site like this, then just use what we did earlier with the algos, see how it all ties together, and then you can go and look at that data later in the day. If you're on the pre-market live call, you actually heard me say at one point there, I don't have time to go through all this right now because I don't have a research department. So I have to go off of different things, and then I can spend time later in the day drilling into that and explaining it. All the sites I gave you were free. I used 2 sites, Trading Economics, and I used Fred. You can use those sites and drill into all that data as well. Why is all this important? Here's CME FedWatch. Okay, CME Group. All you have to do is type CME Group and then just type in FedWatch tool. All right, anybody can use this. Again, free site. What is this telling you? This is the current target rate on where you're at. The next thing that we're going to get into is the complete disparity that's going on and why people are so wrong about regional bank and how they're actually making way more money than people think they're making. I'm going to explain it very, very quickly and very simply so you can say it. But what is this telling us? Here's the 31st. This is the first Fed meeting, right? You're going to want to look at regional banks. I think people are making a huge mistake there if they're not looking long-term at regional banks right now. And it's worth our time. This is where you're at. This is what they're predicting. This is where you're at. This is what they're predicting. Here's January 5th. Right? You're at 6.2%. Here's where you are now. Do you have a big move? Do you see a big move after last week? No. You had this move, right, on the 6th, and then you had this. Anybody jumping out of their skin here and looking at this and saying, wow, that's really different because this data was released, right? Are you going to see this change on Monday, Tuesday, next week? You might want to watch it, right? And I'll watch it with you and we can talk about it in the pre-market or you can mention it in the comments. I do read all the comments and we actually do have a discussion board in there. We're pretty good about weeding out all the bots. But why am I telling you this? Because you're going to want to watch this and you're going to note that it's not going to change. It actually might go up. The percentage chance of a rate cut in January may actually go up based upon the non-farm payrolls. Okay, really important that you get this concept. Now, there's a couple concepts we're going to go over here, but before we do that, we're going to refer to regional banks. And why are we referring to regional banks? Because this trade is completely, in my opinion, probably the most misunderstood trade out there right now. If you're taking a look at our key levels right here, you can just see how we're holding right in that level. Okay. Now watch when we just pop in the most simplest of indicators, how you got to the 22 and what did you do? You held. What's happening with the RSI? It's starting to curl up. Now, there's a couple key things that we're looking at here. Number one, how do you trade this? Individual names. Number two, how else do you trade this? DPST would be the easiest way to trade this, would be the 3x way to trade this. This is a cup, this is a handle. I don't care if you believe it, it is. So if you can see how you're sitting right on this level, right on the 22, and you bounced and you flipped and you stopped dead there. Let's take a look at something. So here's my level, and I was too busy with other trades to actually do this. I did it later in the day, made some money with it, but there's a much longer term trade here in my opinion. I don't know if next week's the day, but you need to get this concept. What this is doing is it's tying into non-farm payrolls, why they're probably going to cut rates more than you think they are, why these bond trades are not the worst idea in the world, but we'll get to it. So if you can see right in here, let's get rid of all my little lines and let's get rid of this. I'm gonna have to clean these charts up at some point. I wanted to say thank you to everybody for sharing these videos. It means a lot. It also means I don't have to run ads in the middle of them. So please share. It helps greatly combat the algorithm that once the ads run, I purposely do not take sponsors. I get asked all the time. I'm not going to bore everybody with that. So I do appreciate you helping out and battling that. And if you find value in it, you should share it. And I do appreciate the comments on how to make the videos better. That's why I can pack more in now because of your comments. When you guys are not as worried about the editing, that just lets me know. So, all right, let's get to it. All right, so what happened? Well, I thought non-farm payrolls was bad. So why are they buying bonds on Friday? Why are they buying regional banks? I thought it was bad. So it doesn't really look bad, does it? All right, so let's just go here. So what happened to regional banks on Friday? It really looks like someone couldn't buy enough of them, right? Did they ever get back to that opening price? No. Okay. What level did they even remotely get back to? Pretty much the previous day high is where they got back to. Okay. So again, it's not the sexiest group out there. I get it. It's not like AI and, we're all wondering if it's going to turn into Terminator 2, but you need to pay attention to them because there is a way to, profit from this. So if we take a look at this and we just take a look at how this is playing out, this is a cup, this is a handle, and deal with it. But there's a couple things out there that are huge misnomers. So in front of you is the Bank Term Funding Program. Now, this is the emergency program that was put in out there that shows that this is where regional banks can go to borrow money. And this is what's happened since January when it started, when we had the regional banking crisis. This is where that is to now. Well, we're at all-time highs. So clearly things are really bad for regional banks, right? They must be awful for regional banks right now. Now, if you're in the community, you already know this. We went over this a couple days ago where I talked and said, retail is selling regional banks. Goldman is out raising their target prices on 17 regional banks. There are 17 in here. Get rid of this Mobley. I'm not going to edit all this out. But you get where I'm going with this. So this is where they are on banks, and this is them raising target prices. Even on the ones that they have sells on, they're raising their target prices. Well, I thought that they were borrowing a lot of money, and I thought this was really bad. So now we have regional banks bouncing on a high non-farm payroll number. We have Goldman coming out and raising target prices on 17 regional banks. And what else do we have? We have smart money, dumb money. And as we refer to this as institutions and retail. Well, we're breaking here. Well, who's buying? Institutions are buying. Who's selling? Retail's selling. How does this all tie together? I'm glad you asked. So who buys 3X ETFs? Well, it's not institutions, right? All right, so here you start out January 24 and you start ripping. Start coming up and look at what happens right here at that 2 o'clock level. And you start to see this, what happens? Well, okay, so we have a ton of data that was dumped on us. We can get into all that later. We can talk about, the Fed minutes and all of that, right? But you can see right here how you just start getting dumped around 2:30. All right, well, why is that happening? Okay, a lot of redemptions are done, and then they do their calculations on these ETFs, and then they have to buy and sell the corresponding underlying asset, right, of what DPST is. So that's pretty interesting, isn't it? Then you come here and then you look at when Fed minutes came out. And then you see right in here how 2 o'clock Fed minutes were released. And then what happens? Well, it absolutely plummets at 2:30. Well, why would you plummet at 2:30? And why did you stop here? See the level you stopped at after all this selling? See how you held here the next day? See how you retested this level? Even though it's lower, you're still on that trend line. See how that played out? Well, why did that happen? So because what's happening is retail is selling regionals to institutions that are taking positions in it. Well, I thought this was bad. They're borrowing from the emergency fund rate. So the quickest way I can get you there is this. Right here, you're going to see this number, right? And you can see them all here, 4.9, 4.94. This is the interest rate that they're currently borrowing at 4.94, all right? All right, so remember this. This is where they can go right now and borrow money. Regional banks can go there and borrow money. And they can go there if it's, quote, an emergency. This is Fed funds. Fed funds is at 5.33. You can borrow, if you're a regional bank, at 4.94 and sell money back to the Fed at 5.33. They're arbitraging. That's why they're borrowing the money. They're not borrowing the money because they have issues. They're borrowing the money because they're arbitraging the Fed against the Fed. Now, for time's sake, I'm not going to get into the whole article, but this is in Bloomberg, and you can just Google this headline and you can read the whole article yourself. Fed likely to end banking funding program in March, Wrightson says. Bank term funding program set to expire March 11th, 2024. Difficult to defend renewal in normal environment. Difficult to defend renewal in normal environment. Well, how can it be a normal environment if there's an emergency going on? The Fed introduced the bank term funding program earlier this year as the banking crisis roiled the markets. The program allows for banks and credit unions to borrow funds up to a year, pledging U.S. treasuries and agency debt as collateral. So not only are you able to do this, think about it this way. You can actually go out there, buy a treasury, get the yield of the treasury, and use that to go and get your loan. And then you take your loan from the government and you sell it back to the government. Currently 484 at the time this article was. Now we're at 494. It's 56 basis points lower than the interest rate reserve balances. Bloomberg goes farther. Since the Fed's pivot earlier this month, the forecasting of interest rate cuts next year, OIS rates tracking them have tumbled, tanking BTFPs with them and boosting the attractiveness of the arbitrage trade. That is why institutions are buying these banks and retail is selling them, because retail is just looking at the cursory information. They're not digging into it, right? Because they don't have the manpower. That's why I tend to do these videos and try to explain how you can get into this, how you can learn this stuff like super quick so you can just like read the headlines and get it. That's what they're doing. As retail is selling regional banks in a panic because they're not going to cut rates, institutions are out there buying them. And they're getting rid of the program that's hitting all-time highs because you're at normal levels. Hope that makes sense. Now, I have some other core concepts I really want to go over. I'm going to go over them Monday or Tuesday. So subscribe to the channel and click all notifications. I tend to try to keep these videos less than an hour because I start to lose people, and I know it's a lot to process, but there's some really big concepts I want to go through, and I'm not going to be able to do them justice as I sit here and look at my notes. I need to get a couple things out before Monday morning so that people are just aware of it. So in front of you is the New York Stock Exchange Composite. What I tend to use is I use the McClellan Summation Index, and you can Google what that is, and you can just look at it on Investopedia, and they'll explain it. Basically, it is something that is calculated off the McClellan oscillator. Right, that is the way to view it. It's basically when two averages cross two other averages and they're near one another. What happened on Friday is something that we have to pay attention to. Now, this is what I said earlier when I said, I'm going to say something and then I'm going to show you later and I'm going to show you data that contradicts a little bit what I said. I really don't care. Right? My job is not to tie my ego to anything. My job is to look at the market and say, what is happening? And then how do I profit from it? Everything else is conversation, right? You're not doing this for ego. You're doing it to make money. You need to understand there's a huge difference between that. It takes a while, usually after you get cracked a couple of times. See where you are. So for me, this 500 level, every time we've gotten near this 500 level, what has happened, right? If we roll at this 500 level, we tend to come back down and crack and break the zero line. Right? It's happened here and it's here. Now, it's not all the time, but it's certainly something that we want to pay attention to because we're starting to roll again. And if you start to roll up here and you start to look at the other times when you've been up this high, people say that this line should be higher. Market's telling you that this is the level that they tend to use. You can even see here and then it consolidated before ripping. It could do the same thing here, or it could stay here, cross and drive me, it'd be maddening for about a year and a half. But then again, you had $1.7 trillion there. So it's really hard to take anything from this because it was Candyland. So this is what we have now, and this is what we're dealing with, and we crossed. And I think this is a really important concept that you should be paying attention to. And we went through a bunch of these other indicators that, in my opinion, as someone likes to say, are absolutely glaring, where you are seeing that you have peaked. But some of these have already started to settle down. Let's get rid of this. But you still get stocks above the 5-day moving average. Right? You're starting to come down a little bit there. You're starting to see stocks above the 20-day. They're already backing off. But you still have stocks at the 50-day at a historic level that usually signifies a medium-term top. Not a short-term top, but this really gives you a medium-term top. You usually have to flush in some capacity once you get to this 90. And if we look at these time frames from December to March, we start taking a look at these, and it doesn't always matter because here's December 22nd, and then you can see how you got to January, and then you went up again. And this was a great time to buy stocks in here. This is a great time. Right? So you don't not buy stocks because of it. You just have to be cognizant that the big push that you just saw from November to December, January, right, just took you from 17% of stocks being above their 50-day moving average to 87 above it. Okay, so that's all you're doing here. You're just looking at these demarcation lines like when you get here, and you take a look at this, you'll note that usually we pull back. And if you go and just take a look at the S&P, this is S5TH, and you can go look at this yourself, that you will see this real clear here and how this is playing out, right? Okay, so these are indicators that we need to pay attention to. Now, what about sectors and sector rotation in the bond market? Well, for me, I don't see anything crazy. I see XLRE pulling back. What I see them doing is I see them buying names that are trading under book value now. I see them going after assets that are trading under book value, which makes sense because rates are going to drop. Whether or not you believe it or not, rates have already dropped, and it's cheaper for commercial real estate people to borrow money, cheaper now than it was a year ago, 6 months ago, 3 months ago. So now they have more flexibility. So those assets, as we're all waiting for, people think that California is going to turn into fallout, but spoiler alert, it's not. So you start seeing things over there that are trading at 50 cents on the dollar. You might want to start looking at some of those names. I'm not going to get into all of them right now, but there's a lot of names that are trading at huge discounts to book value. We can do it later in the week. If you're interested, just drop comments below. I'll go through a bunch of them. So this is one of the sectors I'm talking about. Now you look at this sector and go, well, I don't want to get involved. Okay, I use a 12, a 22, and a 55. You should use what you're comfortable with. I came right to the 22. Who's in charge, the Bulls or the Bears? All right, there's really not much more for me to say. Regional banks certainly look better than the SOX, don't they? Right? Certainly looks better than the SOX does. Certainly looks better than XLK does. I mean, Apple looks like a dumpster fire. So if we start looking at this and putting the pieces together, what is this telling us? Well, this is telling us that we're watching money flow into different areas. And if we're going to watch that money flow into different areas, that's something that we're going to want to pay attention to, right? As we just talked about, look at XLF. Look at how XLF can't break what? The 12. So if XLF can't break the 12, then what is that telling us? Well, that's telling us that money is flowing into the large cap names, right? Regional banks, or I'm sorry, the big dogs. All right, so here's JP Morgan hitting all-time highs. Well, why is that hitting all-time highs if things are so bad out there, right? Like none of it makes any sense if you follow the common arguments about how bad things are. As JP Morgan hits all-time highs. It really doesn't make any sense. Goldman, I tried to trade this week. The trade really kind of just busted out, frankly, but there's this huge flag sitting right there. I actually lost money on the trade. I just got stopped out, broke the 12, and went from there. I had too many other things that are working. And there's some names that you really need to pay attention to that I'd rather spend time explaining these names and why you have to pay attention to them than going into a deeper topic, right? So at least you have more that's actionable this week. I'm always trying to figure out how to add value, and I think that this is a better utilization of our time. Now, as I stated, there's a lot to go over, and I'm just going to give the quick and dirty, but there's a couple names that I really want to get to. And I just want to point out everything so that people get it. This is from January 24. This is a sector graph. Anybody can do this themselves, but it tells you what's going on in line form. And really what you're doing is you're just comparing it to the S&P. Where's the S&P up since January? Where are the players? Okay, they are buying Utes. They are buying healthcare. Okay, they are buying commodities, they are buying financials, and they are buying biotech. So if you're out there and you're trying to figure out where you should be putting your money and you don't want to be playing with the Utes and you don't want to be playing with healthcare for some reason, it takes you to financials, takes you to biotech. All right. Doesn't mean that these sectors don't start getting better, the cloud and the SOX, but if you're playing the game right now, you have to go where the money's going. Right? Unless you're going to start looking at the value plays like I'm doing with some of the XLRE names. But that said, there's two names that I think you should focus on. Now, CYTK had excellent data. You can see when the rumors started that they were looking at being purchased. The data comes out, stock forms a flag. This is something we've been playing with in the community for some time. Just disclosure, I'm extremely long this trade. It's kind of complicated the way I'm in it. I actually own stock, puts, and also calls, and then I sold calls against some of the stock. But I can actually walk through how I'm hedged on it. I think it might be a fun video. But purpose of this is JP Morgan conference, healthcare conference starts next week. This is the one that everybody thinks is probably going to get acquired. Let me just say it this way. The one that we always think is going to get acquired is the one that doesn't get acquired. That's not the worst thing for this company. It would not be the worst thing. It could become an absolute monster. So this is definitely one to be focused on Monday. They speak at JP Morgan at 10:30 Eastern Standard Time. It will be extremely volatile. If they speak and he says we're not going to get acquired, stock can drop, might present a buying opportunity no matter what. This is definitely one that you're going to want to trade around or watch. And you're going to want to watch healthcare names next week. That is the single greatest conference in healthcare. It's actually one of the best conferences of the year. JP Morgan, it starts on Monday, we'll go over it pre-market live. I'll have some ideas and some names that you should be looking at. So make sure you watch the pre-market live. I'll go over a couple of names that you want to watch that day. ZIM, start understanding what's going on with these trades, that they are not being forthright. Now, what do I mean by they're not being forthright? This is from Goldman, and I apologize for how it's cloudy, but this is what's going on in this oil flows to get through this straight. Look at how oil flow has dried up in a month. They're not being forthright about what's really going on over there and how difficult the situation is. ZIM has a route that takes you from Southeast Asia to Baltimore. They're the only ones that have that route. I'm not an expert in routes. There are people that are an expert in routes. Some people have commented below. Please keep those comments coming. Other people read them and they learn from them as well. I would not sleep on ZIM. These tanker stocks as well, I like them. I like the action. I like how you had the pullback and then they just completely reversed. They made you think that they were going to break down and they just have not. So the ones that I'm focused on are STNG, and I am also focused on TNK, and I'm really focused and I have a very large position in this ZIM. And I think ZIM has huge potential. We have to watch that 1550 level and see what's there. My thought on this, and I want to just end with this, TLT for me is a very long-term trade. I keep getting asked about this because we bought this in the community here and people have been following for some time. I'm willing to ride this the whole way back down. I don't think that we see this again. That's the way that I'm viewing the world. This is a very long-term trade for me. If this was a trade for you, then you have to just kind of look at what the market's telling you and realize that maybe we got a little overheated and that this can actually come down. And now if you just drop a level right here, you're going to see that level right there. So if you break that level, you have to think that, okay, well then maybe 94 is on the table, and you have to start thinking that way. Are you willing to ride this all the way back down? If the answer is no, then you need a process that's probably different than the one that I've been, espousing on here. Same thing with high yield. I love the way high yield looks, but if you are looking at these as trades, you have to know who you are as a trader. That's it.